Thanks everybody for joining. This is Quinn Arnold, and with me today, as always, is Matt Hilland. Matt is one of our planners at the firm, and we'll be talking through some of the planning opportunities that you might find from your tax return this year or in any year. And it will be fairly detailed, and I think that's what people need when it comes to taxes. But we also encourage you, if you have any questions for your own situation or want to get some feedback on your own tax return, to let us know. And certainly if you are one of our ongoing clients, we do plan to always address this in upcoming meetings as we get your taxes done with you throughout the year. So one other plug here too, because we do have people that listen to these webinars afterwards, and we encourage those anybody today to send us topics that are of interest to you. We primarily do these webinars based on what our clients find interesting or helpful to go through in a little bit of a longer format than just like a quick blog post or a quick video, because we do some of those as well. And so please, if you have any questions after today, or if you have thoughts about other topics that are of interest to you, please go right ahead and email Matt or me those suggestions. So with that, I will turn this over to Matt to talk to you about identifying planning opportunities from your tax return.
All right, thank you, and thanks for joining us again. We know this time of year, you probably just want to hit submit and file your taxes, or maybe just confirm with your tax preparer that everything looks good, and never think about taxes again for another year. But for us and for a lot of our clients, this is the perfect time to kind of get to work and review where there might be opportunities in the future to save on taxes or qualify for other benefits. And so we're going to look into detail at three big items that apply to a wide variety of people, but everything we talk about will certainly not apply to everyone. Chances are something will almost certainly apply to you, but there's just so many different items in the tax code that apply to specific segments of the population. It's pretty much impossible to do a webinar like this that'll be comprehensive to you and then also applicable for a number of other people. And so just kind of keep that in mind. Our big goal here is just to give you an example of the wide variety of opportunities that are out there, and take a look at why we're even here talking with you about tax planning. And it's because there are thousands and thousands of dollars in different tax credits and deductions and benefits in the tax code that is dependent on various levels of income. And so just for a few examples that are shown here, this table shows the name of the tax benefit on the left column there, and the income limit to qualify in the middle. Just a quick disclaimer, these are income amounts that do change every year or most years. These shown here were for the 2021 tax year, but will not be the same for future tax years. And then these numbers also change based on your tax filing status. So shown here is numbers for married filed jointly couples, but these numbers differ if you're single or head of household. But just as a few examples, notice that there can be added taxes on your investments based on your income. This is the net investment tax. There can be thousands of dollars in tax credits for those of you going back to school or maybe helping children pay for college. There's thousands in tax credits for those with low income who save in retirement accounts. There's opportunities for households to get thousands in tax deductions if you can qualify for IRAs, child tax credits for even very high income households. And there's always new opportunities that pop up every year too. So just in the last couple of years, for example, we saw stimulus checks that were sent out just based on where you fall in certain tax brackets. And so, we wanted to start out here, hopefully just to show you why tax planning has such value, whether you're a young family working, middle-aged with kids entering college, high income, low income, or retired. There's just a lot of opportunities out there to reduce your tax bill with just a little bit of planning. And so besides all those special deductions and credits, there are certain tax rates that apply to everyone, just like the income tax brackets, for example. And because even just the basic tax brackets, that apply to every single person provide a lot of planning opportunities. And you can see here, there are certain levels of income where once you start going above result in relatively big jumps in tax rates. And so a married couple here with income that goes above, just say $172,750 might just be subject to an added 2% tax rate going from 22% to 24%. And, while 2% increase might be worth planning around, there's bigger jumps here. Notice like in excess of 81,000 or 329,000 in income. Any increases in income above these levels result in an 8 or 10% increase in tax rate. And, no matter who you are, 8 or 10% of your income is a significant amount of money. And so planning around some of these levels can be really important. And the other reason we find tremendous value in tax planning is because the tax code is, I guess, quite simply just complicated to navigate. And just to show you a few examples, the income tax rate we were just showing is pretty straightforward. That's based on what's called your taxable income. That's a line right on your tax return. And so just shown here on a simple 1040, this year it was that last line 15 on your 1040. For this example, 108,000, that's where you fall in the tax brackets that we were just showing. But not everything is that simple. For example, the IRS restricts the ability to contribute to Roth IRAs based on income, but it's not based on your taxable income. It's based on a modified calculation of that income, which takes your taxable income, adds back standard deduction or certain deductions that you took, also adds back in part of some taxable retirement account distributions. And then there's other things like Medicare's premium or IRMAA, the income-related monthly adjustment amount, that is, not based on taxable income, not based on adjusted gross income, not even based on that modified income that determines Roth IRA eligibility, but something completely different altogether that takes, your AGI, adds in certain portions of untaxed Social Security benefits, adds in tax-exempt interest from, say, municipal bonds. And all this just leads to, it being relatively complicated to figure out the certain income levels that apply for all these different benefits also. And then, let's just say you have a child with student loans. You might be eligible for a tax deduction based on that. And to determine whether you're eligible for that, I can't even make enough arrows on that 1040 to make it make sense. There's a 14-step worksheet to figure out your modified adjusted gross income to determine if you're eligible for a student loan interest deduction. And so, just to give you some examples here to show you that there's a lot of different areas around the tax code to plan around. We won't and can't cover every single benefit that's out there just because simply there's too many. But we thought it'd be valuable to look in more detail on, like I said, just 3 of these larger opportunities that we see that apply to a large number of people. And the first one that we're going to look at is just those income tax brackets that we looked at before, and helping you understand where you fall in these income tax brackets and the planning opportunities just around this. Because knowing where you are and knowing when you might have additional income or less income can result in big jumps or reductions in your tax rate. And so just as an example, let's say if you're a married retiree taking regular monthly withdrawals from your IRA, you also have certain Social Security benefit, recognize a certain amount of dividends or capital gains here. You'd fall in right in the middle of that 12% income tax bracket as we're showing here. And then let's just say, for example, that this couple wants to buy a $40,000 car this year. And let's assume that they just take that extra $40,000 out of their IRA, take a simple, one-time withdrawal. this causes $40,000 more in taxable income. And as you can see in this new picture here now, they're no longer in the 12% bracket. They have about $20,000 that are now getting taxed not at 12%, but 22%. And so you can see, right here that this is $20,000 taxed at a 10% higher interest rate. And so what's the planning opportunity here? There's a lot of options, but just for one example, let's say this couple can space out IRA withdrawals over 2 different tax years. So maybe $20,000 withdrawal in December and a $20,000 withdrawal in January. Just this would prevent any of the IRA withdrawals from falling in the 22% tax bracket, effectively saving $20,000 from being taxed at that 10% tax rate. And so right here, relatively simple example represents, maybe a $2,000 tax savings for this retired couple, and not bad for just what would be a car purchase. And we can do other things too besides spacing out withdrawals. That doesn't always work. Maybe we can pull $20,000 from an IRA and $20,000 from a Roth IRA. Distributions from a Roth IRA don't count as taxable income. We can kind of pull a lot of different levers here when we're planning around income tax rates. And so hopefully you can just see here that there's a lot of options to think about and a lot of ways that you could end up, saving money on taxes or potentially cause yourself to pay some extra in taxes that you could avoid with just a little bit of planning, analysis, and being aware of where you fall in these tax brackets. And so in general, how should you kind of think about opportunities and what impacts your income tax rate? First, it's just important to know what does contribute to this. And so wages from your job and then IRA and 401k withdrawals are the primary driver for most, but there's others here too, just depending on your finances. Maybe you have a pension, maybe you sold some stock and have short-term capital gains. Maybe you're doing Roth conversions. Also, a portion of your Social Security falls into this category, depending on your other income. And so it's important to know that, in years you expect higher IRA withdrawals. That should, maybe trigger something that, yep, I should check where I'm at in these tax brackets and see if I'm bumping up brackets or, if we don't do as much travel this year, maybe I'll be down in a lower tax bracket and should take advantage of that. And then also what reduces taxable income. So pre-tax 401k contributions are the big one here for working families. For a retiree, maybe it's tax loss harvesting. That can be a big impact, especially in times like we're seeing today. Health savings account contributions, if you're eligible for traditional IRA contributions, all that can reduce your taxable income. And, if done at a proper time, might be able to take you down from 32% tax rate to 24, for example, and be a very valuable tax deduction. And then also for a retiree, reducing this income tax rate might be hard, but maybe the bigger impact is knowing just what doesn't have an effect or what doesn't contribute to taxable income. So like I mentioned before, Roth IRA distributions are tax-free, not taxed at income tax rates. Investments from certain tax-free bonds like municipal bonds do not fall into this category where interest from normal bonds does. And then if you have a taxable brokerage account, the cost basis or the original investment that you put into those accounts can be distributed tax-free also. And so just important to know those few, again, levers that you can pull to still get money when you need it, but have different impacts on where you fall into these different tax buckets. Another big tax planning opportunity that we see is around Medicare. And this is because your Medicare premium or what you pay for your insurance is dependent on your income. And if your income goes above certain thresholds, you get charged an income-related monthly adjustment amount or IRMAA on your bill. And so IRMAA is one of the very few taxes that is triggered with just $1 in income above a certain threshold. We were looking at the income tax brackets before, and only dollars above a certain bracket are taxed at higher rates. That's not the case here with IRMAA, where, for example, in this image shown here, a married couple with $182,001 in income here is going to be subject to that first IRMAA surcharge, and is going to result in about $80 per month per person added to their Medicare premium. And so you can see, close to $1,000 there just from that $1 in extra income. And so, of course, everyone over age 65 is on Medicare. So this is immediately applicable to a lot of people, but also that we know eventually everybody's going to be subject to this. So even if you're younger, you can do planning now to help avoid this in the future. And so if we can figure out that to plan around this is based on your modified adjusted gross income, sometimes called MAGI. And if we can do things that we know are going to reduce your MAGI in the future, that can be a very valuable planning opportunity, even if you're not even really thinking about Medicare yet. The common scenario here, the bigger problem that we see for retirees is that RMDs, or required minimum distributions, end up pushing retirees into these higher and higher IRMAA brackets that we're seeing here. And so, if you're younger, maybe we can advise you to direct more savings into Roth IRAs, where in the future that won't be taxable, won't contribute to you kind of climbing these IRMAA brackets here. Or maybe we can do Roth conversions to try to prevent a retired couple from having significant enough RMDs that are going to trigger you stepping up on these brackets. And so, again, no matter who you are, for a large number of people, planning around this just for Medicare alone can be really valuable. The last main topic that we just wanted to touch on today is planning around capital gains taxes. And so this is gains that you have on a brokerage account investments. A lot of people, if they've saved outside of 401ks or IRAs, have these types of accounts. And there's big opportunities here because this is one of the few chances that a lot of people have to get capital gains out at a 0% tax rate. And even if you can't get it into the 0% bracket, tax rates on capital gains are less than income. And so for high spending years for a retired couple, for example, it's probably worth, or it might be worth, paying 15% tax rate on your long-term capital gains rather than 24 or 32% tax rate on IRA withdrawals. And so to plan for this and to see where you are in the capital gains brackets, this is pretty easy to see from your 1040 tax return. And so again, this is that taxable income line 15 on your 1040. And that is going to exactly show where you fall in either the 0, 15, or 22% tax bracket, or for capital gains tax bracket, sorry. And then from here, you can look at the opportunities that you have. And so, for example, now this image is showing a retired couple with $38,000 in taxable income. They could purposely recognize $40,000 in capital gains, and it would have a 0% tax rate. So maybe this is an example of a retiree that has low income for 1 year, just maybe living off of cash savings, maybe not doing IRA withdrawals, just not a lot of spending goals. And they might think, oh, this is great, I have a low tax year, not realizing there's an opportunity here to purposely recognize some gains all at 0% tax. We call that tax gain harvesting sometimes, and it's kind of maybe an overlooked part of the tax code here, seeing where you fall in these brackets and really taking advantage of it. And then the last item we had in our agenda for today is doing tax planning around, that dreaded bill that you have to send to IRS every year. And so if you find yourself doing your taxes and then having a fairly sizable tax bill due? What are your options? And so this is kind of different for whether you're retired living off your investments or still working, still have a salary. For retirees, this is a little bit easier of a thing to handle. You can withhold taxes on IRA withdrawals, for example, send money automatically to the IRS every time you take a withdrawal. And so maybe for you, it's just tweaking the withholding percentage. If you're withholding 10% and you have a big tax bill at the end of the year, maybe we can withhold 15%. And just make it so you don't have to write a big check at the end of the year. And there's a lot of flexibility with tax withholdings and IRAs that make this, I think, a really good way just to manage your tax liability. I think a lot of CPAs push like quarterly payments a lot, and we just find it a lot easier to just do a couple extra tax withholdings and not have to worry about submitting quarterly payments and hitting safe harbor amounts and things like that. And so again, you can either just bump up regular withholding amounts, or at the end of the year, you can send in just large withholding amounts to kind of true up your tax bill. For workers, it's a little bit more complicated, changing the withholding on your paychecks. And we find it's always just a little bit of a confusing process to figure out how much more to withhold from your wages. And so this is something that we're always happy to walk through with you, but the IRS makes really easy to figure out what part of your paycheck or how much of your paycheck should be withheld. So I'm showing a screenshot here. If you just kind of Google IRS tax withholding calculator or estimator, you're going to arrive at this page here. It's a very well-designed tool by the IRS, walking you through things like your income, what you're withholding. You can fill this out. If you just have your most recent pay stub, that has everything you need to go through this tool from the IRS. And eventually it's going to, ask you a series of questions, and it will give you a result on what you're on pace to, maybe either owe or get as a refund. And so that alone can be valuable to help you know and plan ahead if you are on pace to have to write a big check or get a big refund. But it also has a really nice feature where it'll pre-fill out a W-4 for you that you can simply sign, put your name on it, print out and give to your employer, and it'll tell them exactly what to put in for either added or reduced withholdings, special one-time withholdings. It makes it very easy rather than you trying to figure out how to fill out this form just based on looking at your pay stub. And so maybe just to summarize here, some bigger takeaways with this information. What should you do now to help plan for your taxes? And I think the simple thing is just try to think ahead about how your tax picture may change compared to last year. And specifically, the big thing that we see cause trouble is changes in income. I put income in quotes here because sometimes that just means IRA withdrawals, not necessarily wages. But if you got a raise or a big bonus, if you have RMDs kicking in, if you received inherited IRA, that's going to cause some accelerated taxes for you. If you have higher spending, that's going to cause you to tap retirement accounts or sell stocks and trigger capital gains. These are really common things that almost every year you have some kind of variable amount of income, and that should just kind of trigger you to maybe look at last year's tax return, see how that's going to impact it, and just make sure you're not going to hit any of those kind of cliffs that we looked at, different income tax rates, IRMAA tax rates, capital gains tax rates, and things like that. And of course, we like to make sure that this is something we are certainly happy to help walk you through with, but that there is some responsibility on you too, that when we are bugging you a couple times a year on, hey, what spending do you foresee? This is why, and this is kind of the reason that we like to check in with you fairly regularly on goals and on spending, because they can have big impact, and there can be big benefits to kind of planning around some things like that. And so with that, that's all we had prepared for today, but please ask any questions if you have. You can ask them now if asking in front of the group's fine, or we're always available for phone call or email afterwards. And with that, thanks for joining us on your Friday afternoon here, and have a good weekend.